It's time for another episode of Stansberry Radio, the show that's too loud for radio. Here are your hosts, Porter Stansberry and Aaron Brabham.
Welcome to Stansberry Radio, everybody. This is Porter Stansberry, your host, and I'm sad to report that my co-host, Aaron Brabham, is out for this week. Normally, I'm the guy out traipsing around the world doing, sort of foolish and sometimes interesting things with my time. But this week, it's Aaron, and I'm sure he wouldn't want me to tell you where he is. So I will. He is at a music festival in Palm Springs called Coachella. I have no idea what goes on at Coachella, but following along on Facebook, I can tell you that it seems to involve a lot of people in their 20s and a very, very huge mansion with a gorgeous pool. That's really the only information I have about it. You probably know more about Coachella than I do. See, I'm a guy in his 40s that lives the life of a 40-year-old. Meanwhile, my co-host, Aaron, is a 40-year-old who lives the life of a 27-year-old. And I really don't know how he gets away with it, but he did, and it's pretty extraordinary what he's been able to accomplish in terms of fun and with his spare time. So he's not here today, and as a result, we're going to be lacking a lot of the back and forth banter. So what I did was I went out and I got pretty much the smartest person in the whole world when it comes to finance and economics. His name is JİM RİCKARDS, and he's going to be our guest on the program in just a few moments. But before we get to Jim, I did want to say one thing, and that is that you may have noticed that the stock market has been a little bit weak lately. And a lot of the high flyers, the stocks like Tesla and Twitter and Amazon, that we have been warning people about, either specifically or generally, for many, many months, have seemed to roll over and begin to fall out of bed. And I want to urge folks, if they haven't yet, to check out the Friday Digest that I wrote last week. It'll be in the Digest archive on Stansberry Research's website. It's available for subscribers only, and I'm sorry, that means you have to shell out all of $49 or $79 to get access, which you will have if you buy any of our products. So you can subscribe to anything and you'll get access immediately to the Digest archive. But check out the Digest I wrote last Friday, because in that Digest I have summarized the 4 or 5 different specific warnings we have been giving people about the overall level of the stock market, and particularly the level of these very inflated stocks. And to demonstrate this, we took the blacklist. And if you follow my newsletter, you know that the blacklist is essentially the list of the world's most overvalued equities. And to qualify to be on the blacklist, you have to have a stock that's worth more than $10 billion in terms of total market cap. And all that means is if you took out all the stocks, all the shares that are outstanding, you added up all the value, you'd get more than $10 billion. That's a pretty big company. I mean, there are a lot of big companies out there, but $10 billion is a very large cap stock. So large cap companies are generally not going to be valued so much on future growth as they are on what they're earning right now. Whereas if you had a smaller company, a $500 million company or a $1 billion company, you could see how it might be valued at a very high multiples of sales and profits because it was obviously going to grow into a bigger, more valuable company. But once you get to $10 billion, it's really hard to sort of make a lot of those super growth claims. Now, I'm not saying it's impossible, and there are some companies from time to time that do justify high valuations, even at a very large number in terms of market cap. But it's sort of like Lake Wobegon. They can't all be that exceptional. So by looking at all of them, we simply can know that the market has gotten to be radically overvalued in terms of that growth space. So during the periods where markets are making a bottom, we have seen that there will be less than 5 companies anywhere in the stock market that are valued at more than $10 billion and trading at more than 10 times sales. So sort of the froth is out of the growth section of the market at market bottoms. Meanwhile, at market tops, so these are periods like 2000, 2007, at market tops, we have seen that there are somewhere between 15 and 20 names on this list. And that means that, in our opinion, investors are putting far too much confidence in way too many companies' ability to make unbelievable amounts of growth going forward. So, At some point, I believe it was in early March. It might have been late February, early March. At one point, there were 28 stocks on our blacklist. 28. Now, that's the most I can ever remember seeing. I'm not saying I can't guarantee there weren't more back in 2000 because we weren't compiling the list in the same way back then, so I can't guarantee it. But I don't think I've ever seen more. And so what you have, in my opinion, is you have an enormous amount of overconfidence that the Fed can successfully navigate a depression without a debt liquidation. And I will just tell you that I think that's very unlikely. I think sooner or later there's going to be a lot of negative consequences from the fact that we didn't write off a lot of bad debts 5 years ago. You also have enormous amounts of investor confidence in these new startling companies. So look, Tesla may, in fact, have made the very best car in the world. Maybe so. And that car may, in 10 years, 20 years, become the new global standard. But along the way, it's going to encounter a lot of competition. And there's no doubt that there's a tremendous amount of overcapacity globally in auto manufacturing. So the odds that Tesla will be able to sustain investor optimism in a uniform way over the next 10 years, I would say it's zero. So we were writing and warning people that these stocks surely had to correct. And to show what we saw, what we did was we took all of their share prices and we put them into one index. So it's as if we built our own ETF of the world's most overpriced stocks. And by the time we compiled our list, there were only 22 names on it. This was about a month ago. And what we have seen is that this homemade or proprietary index that we've created is an absolute vertical free fall. And what I believe, and I've said this in many places, is that the big bear market in these radically overpriced stocks is going to spill over into the general markets. And I believe 2014 will see a significant correction. As I've said, I think the average market multiple could fall as much as 50%. Certainly, the market multiple of those very expensive stocks will fall by that much. And I've been saying this, pretty much uniformly for some time now. And I put the excerpts of all the things that we had talked about, all the signs we saw. I put them all in the last Friday's digest. And if you have any money in the market, I urge you to at least consider what I've written carefully. And if you want to try to make a profit as this market falls, then I think what I've written is invaluable, and you have to see it. There is, of course, a way to protect yourself as markets fall. You can buy puts, you can short stocks, or even simpler, you can just move your money into short-term bonds. And, the purchasing power of that money in terms of stock price is going to appreciate. So you want to make sure you have cash at the bottom. Now, whether or not you're going to get out of long-term positions, I can't judge. I'm not looking at your portfolio. I'm not going to sell either of my two long-term investments. I'm going to keep them. Likewise, I'm not going to sell stake in my own company. I'm going to keep it. So what I'll do instead is I will do some speculating on the short side to try to generate trading profits to offset whatever the decline is in my long-term holdings. That's my strategy, and if you want to adopt it, I'd urge you to read last Friday's digest. And, of course, continue to listen to Stansberry Radio. We will keep you informed. When we get done with the interview with Jim Rickards, and he's going to be coming up right now, but when we get done with our interview with Jim Rickards, we're going to talk about one thing that all investors suffer from. And I have some new numbers to give you from this study of actual investor performance. It's called the Delbar study, and they've been releasing it annually for about 25 years now. I know you'll find it fascinating, and we want to talk about it on this show. But first, let us get to, like I said, probably the smartest guy in the whole world when it comes to global finance and economics. Jim Rickards is a best-selling author. He has 2 books out there. One is called Currency Wars. It was written in 2011. And 2011 was right at the peak of the real problems in the dollar. It was sort of the low point in the trade weighted value of the dollar. And, Jim was very prescient in predicting the problems that a weaker dollar would cause around the world. His new book, though, is called The Death of Money. And in it, he talks about how the global currency system is progressing to a post-dollar world. And this, of course, implies huge risks for all Americans and for anyone who has most of their assets or most of their savings in dollars. I hope you'll join me in giving Jim Rickards a very warm welcome. So Jim is the author of the best-selling book Currency Wars, and his new book out is called The Death of Money. And there's probably nobody else in the world better for us to talk to than Jim Rickards, because it seems like the entire Fed policy, global central bank intervention to keep asset prices up is beginning to slip.
I think that's right, Porter. They've been keeping it up for a long time. And, one of the things that analysts and some others have missed is, because people have been talking about the collapse of the system and the collapse of confidence for a long time, it is definitely coming, and I talked about it in the book. But don't underestimate the ability of governments to keep the game going, maybe longer than we all expect. And you have to take that into account. There's actually a word for it. It's called force majeure. It's a Latin word, but it just means, superior force, of the ability of state power to dictate the outcome.
Yeah,
they can do that in the short run, but in the long run, the fundamentals will prevail.
The markets are going to win. Yeah, I've told people the same thing over many years in my newsletter, saying it's really difficult and risky to try to short the sovereign because he's got all kinds of power and levers. And, he knows you're after him, and he's not going to just take it sitting down. But listen, before we get into the deep economic stuff, I really want to give my listeners a sense of the things that you've done in your career, because I don't think I've ever spoke to someone who has had a front row seat to more important financial debacles. The thing that really jumps out at me is you were the general counsel for Long-Term Capital's hedge fund back in the late 90s, and you guys did a pretty good job at blowing up the world.
We did, and that was a very good lesson for me. I was not the risk manager or the trader at the time. I was the general counsel, and I was certainly on the management team and worked side by side with all the folks there. Now, my job as a lawyer, I wrote the contracts and I actually negotiated the bailout. I like to say when things go really badly wrong, the lawyers take over, and that's what happened. So I negotiated that bailout with the Federal Reserve, which was definitely sponsored by the Federal Reserve, although that was private money. There was no government money used in it. But a lot of people think that the banks bailed us out. They didn't bail us out. They bailed themselves out.
Exactly.
We had a $1.3 trillion balance sheet, and we were heading for zero. We would have gone zero net worth, zero cash. And I like to say, we would have hit zero. All I had to do was sleep in late the next day. I didn't have to go to work. It was Wall Street that would have to deal with the $1.4 trillion. So they in effect, we bought our balance sheet by putting new capital in to protect themselves from the meltdown. But I did negotiate that, and it was very, very educational, Porter, because I came into it as a lawyer, but I came out of it very curious as to what had gone wrong, because these really were smart people. We had 16 PhDs. They really did have 150, 160 IQs and higher. We had 2 Nobel Prize winners. We had the top finance faculty in the world, if you thought of it as a faculty, and yet everything went very badly wrong. And I came out of that and I said, there must be something wrong with what they're doing. They're not dumb. They're not, they don't have malintent. They were trying to do the best they could. They weren't trying to destroy the world, and yet they almost did. And so there must be something wrong with the models, and that set me out on a 10-year intellectual quest. I spent the next 10 years researching applied mathematics, physics, complexity theory, network theory, graph theory, behavioral economics, dynamic systems analysis, a lot of things. And then, first of all, I was able to see what was wrong with the existing models, and then take it a step further and create models that actually do a much better job of understanding how the economy actually works. And that's really the genesis of my 2 books, Currency Wars, which came out in 2011, and The Death of Money, which has just come out. Those books are really the fruit of my 10 years kind of intellectual odyssey trying to understand what went wrong at Long-Term Capital and what we could do to prevent disasters in the future, or at least see them coming.
Let's talk about what's coming now, because I'm certainly... I haven't done even a tenth of the things you just mentioned, let alone work at Caxton, work at Long-Term Capital Management, negotiate these bailouts. And Jim, I must say, you're like the most intelligent, educated man I've ever met. How did you survive all these degrees you've got and still be able to think rationally and use common sense?
Well, I give a lot of credit to my parents and my family. I do have actually 4 university degrees. I just didn't know when to stop, but including a doctorate and 2 law degrees. But look, I came from a blue collar, working class background. I kind of I thank my family for helping me to keep my feet on the ground. I had 5 brothers and sisters. I picked strawberries on a farm. I delivered newspapers in a town. I drove a taxi in the tough city, Baltimore.
Oh, nice. A little time in Baltimore.
I don't know if you know Jimmy's Taxi Company out in Towson, Maryland, but drove a taxi there. So, and I used to, drive a taxi to make tips and then turn in my cab, use the tips to buy dinner, and then stay up all night studying the International Monetary System when I was in grad school. So I think I'm fortunate in that sense that I've been able to have my feet on the ground and be, in the real world.
Yeah, there aren't many smart economists out there that have experience in actual jobs. And I think
look, Janet Yellen I'm sure she's a wonderful lady. I know she's 3 times smarter than I am, but she should be in a university. She should not be running the biggest, the central bank of the most powerful, largest economy on earth.
All right, well, let's talk about that.
She's kind of out in the clouds,
I agree, and I have a good question about that. So I did a little bit of math before we came on the show together. And by my calculations, the Fed has roughly created $3 trillion in reserves. And that's a rough number. I might be off by 100 billion or so, but who's counting?
Right.
So roughly $3 trillion. And if you assume it's $3 trillion, since 2009, the U.S. economy has created roughly 6 million jobs. So you do the basic math, and that comes to $500,000 in new high-powered money, central bank reserves per new job. So the question I have for you is, why is the central bank's policy lever so inadequate to fulfill their dual mission?
Well, there are a couple of reasons for that. One question a lot of people have is, how could you print $4 trillion almost and not get inflation? And the answer is that it's like making a ham and cheese sandwich. You can't do it with just the ham. You need the cheese. The money printing is the ham, but the cheese is what's called velocity, or the turnover of money. So the Fed can print all the money they want, but if people don't want to borrow it, don't want to spend it, and they'd rather stay home and watch TV than go out and take their friends to dinner, then you're not going to get the inflation. And that's the kind of mode we've been in for the last 5 years, and that's because we're in a depression. This is not a normal business cycle type recovery. We're in a global depression. We've been in it since 2007. And that is very largely behavioral and psychological. As I say, the Fed has to basically change the psychology and get people to get out there lending and spending the money again. So that's one impediment. But the other problem is that the difference between a depression and a normal recession and recovery cycle is that depressions are structural. A normal business credit cycle is cyclical, meaning that the economy gets a little hot, the Fed tightens policy, the economy cools down, unemployment goes up, and they go, okay, that's enough. So now they ease policy, and then jobs are created, and the economy goes up again. So it's like a sine wave. It goes up and down, up and down. It's the same business cycle we've seen over and over 20 times or so since World War II. That's not what we're in today. One of the reasons that expectations of a recovery have been disappointed, 2009, everyone talked about green shoots. Those turned brown pretty quickly. The point is, we're not in that normal recovery. Depression is structural. It's a structural problem. You cannot solve a structural problem with a cyclical liquidity solution, and that's the biggest problem. The Fed's trying to use money to solve a problem that cannot be solved by money. It can only be solved with structural changes and a change in confidence. And so, but the problem is they think it can. The fact that it's not working doesn't deter them because they think they can print enough money to get the economy going. And my concern is that they're printing the money to get the economy going. It won't work. It's like treating cancer with aspirin. It's not going to be very effective. But because they think it is, they're going to keep printing and ultimately collapse confidence in the dollar itself.
And very interesting. And I want to get to the collapse in the confidence of the dollar, which clearly is the sort of backbone of both of your books. And we'll talk about that in a second. But I because you just mentioned the idea of a structural change in the U.S. economy, I wanted to ask you about 3 things I see as being different about our economy today. And the one thing is, I think one of the reasons why it's been hard for people to add new labor, to add new employees, is because 65% of American jobs today involve information processing in one way or another. And those jobs are constantly under threat of being replaced by computers and software and networking solutions. And I'm beginning to see this even more and more in finance. And Jim, I know you've seen it too. The number of new smart ETFs, the number of algorithmic trading systems, people all across finance are starting to get replaced with computers. That's just something that I see because I work in that industry. Another example of a structural problem is during the last credit cycle, there wasn't a debt liquidation. So the amount of debt that the U.S. economy is still carrying has never decreased. Now, we've replaced which types, but there is still an enormous amount of corporate junk bond out there, for example, and that never got liquidated. And so now, if you look at junk bonds in particular, you'll see that the mix of credit inside the high-yield market is as low quality as it's ever been. So that means that there are a lot of weak companies that still have a tremendous amount of debt on their hands. And then one last thing, and I would love to hear what you think about this because it's kind of counter-cyclical to what you're saying about the risks to the dollar as the de facto world reserve currency, is the enormous change that has taken place in the U.S. current account deficit thanks almost entirely to the shale oil production. I see all these three things as being inherently deflationary. That is, right, the debt burden, the massive gains in information productivity, and, of course, enormous increases into our economy's ability to produce oil and gas. What do you think about those three structural changes and how they relate to your overall economic thesis?
Well, they fit in very nicely. I agree with them at a certain level, Porter, but let me maybe take it a little bit deeper. On your first point about, robotics and technology and automation replacing jobs, that's certainly true, and that is certainly a structural issue. It's a good example of the difference between a structural issue and something that could actually be solved by money. Printing money is not going to solve that problem. But you go back to 1800. In 1800, 95% of the American people worked on farms. And they produced enough agricultural output to feed themselves plus the other 5% who were living in the cities. But today, 3% of the Americans work on farms, and they produce enough food to feed themselves, the other 97%, and export abroad. So all those agricultural jobs are destroyed. Now, we're not sitting around saying, gee, we need to go back and create all those farm jobs. Why aren't 95% of the people on farms? Those jobs are wiped out, but the economy moved on. We created industrial jobs, we created service jobs, et cetera. And so that's an example of how we shouldn't lament the lost jobs. What we should be lamenting is why aren't we creating the new jobs?
Bingo.
And the answer there...
Hold on, before you go into the answer,
yeah,
let me just tell people the way this would normally happen, and I agree with you, is there was an enormous depression in 1893, and because of the new mechanization that was coming to farms, and that, and of course all the railroad debt, and so those things had to get wiped out. That overcapacity had to get liquidated in order for new jobs to be created. That capital had to be freed up, and it was through the liquidation process.
That's right. So we need that again, and that kind of gets to the second point, which is, you say the debt hasn't been written off. That's exactly right. Now you go back to 2008. What did Bernanke say over and over? We are not going to make the mistakes of Japan. Well, guess what? We made every single mistake of Japan. When Japan confronted their crisis, and they're still in it, by the way, people talk about the lost decade. How about the lost 3 decades at this point? But this started in 1990. What did they do? They did not write off the debt. They did not close the bad banks. They did not fire people and put some people in jail. They did not make structural changes. Instead, they propped up the banks, kept all the debt on the balance sheet, kept the management in place, and made very few structural changes. Flash forward to 2008, what did we do? Propped up the banks, bailed them out, kept the crooks in their positions so they could continue to collect bonuses, and we didn't write off the debt. We should have shut down Goldman Sachs, Morgan Stanley, Citibank, Bank of America, should have been taken over by the government. The equity should have been wiped out, so, hey, stockholders, you get zero. Too bad. Bondholders, you're going to get a haircut. We don't know how much yet, but we'll get back to you on that. Depositors and counterparties, you're protected because we don't want to, trash the system. We just want to clean out the rot. Strip the bad assets out, put them in a government trust for the benefit of taxpayers, sell them over 20 years or however long it takes, give that money back to the taxpayers, and then take the clean bank, IPO it, back to the marketplace so it's privately owned because I don't want the government to own the banks forever. And now you've got a clean bank that can actually make loans.
Yeah, we did that. It was called AIG.
Right, but none of that happened. None of that happened. What happened instead was we propped everything up, kept it in place, kept the bad debts on the book, kept the system the way it was, and kept the people. So is it any surprise that we're stuck in this rut 5 years later? So that's the structural problem.
Hey, can I interrupt again and ask a question about going to jail? You have known a lot of these very high-powered financial people. And the question I have for you is, do you genuinely think that they're crooks? Like John Merriweather, he's wiped out 2 huge funds. Is he a crook?
John Meriwether's not a crook. John Meriwether's a good guy. I think the models that he was using are badly flawed, and I talked about that in my book. And again, having been with him and others at Long-Term Capital Management, I had a front row seat on that. So having the wrong model doesn't make you a crook. It might make you, a bad asset manager or someone who's taking too much risk. I don't think Janet Yellen's a crook. I think she's got the wrong models. I don't think John Meriwether's a crook. I think he's got the wrong models.
Yeah,
but there are crooks. There are crooks in the system.
Sure, obviously.
So
but are they? Are they really the major players? I mean, is the CEO of Goldman a crook? Is Jamie Dimon a crook? Are these people really criminals, or are they just misguided?
Well, I think Jamie Dimon is running a corrupt enterprise from top to bottom. I mean, he's had $30 billion of fines, penalties, legal fees, compliance costs, and still going on. Now, I do know this. Secretary Geithner turned to Attorney General Holder during the height of the crisis and said, do not go after these people because the system is extremely fragile. We're trying to prop up confidence. And if we start putting people in handcuffs and leading them away and putting them on trial, we're going to destroy confidence. So without getting into who's a crook and who isn't, I think it's fair to say that there certainly was some criminal activity during the crisis, and it's also documented that the Justice Department did not go after them at the behest of the Treasury Department because they didn't want to destroy confidence. That is completely corrupt.
What do you think about my solution? I've said this a couple times in different places. I don't know how you'll feel about it, but, there are a lot of countries where the directors of a bank have to be personally liable to the depositors, so that if the government has to come in and bail out the depositors, the government only spends a nickel after all the directors' personal assets have been liquidated.
Well, I think a system like that, we used to have that in this country, by the way. There used to be the law in the United States. It hasn't been for a long time. It has a lot to commend it, whether you do that, which is a pretty radical solution, but I think it's better than the system we have today. There are other solutions, which is much higher bank capital requirements. People say, oh, gee, you're torturing the banks.
Yeah, well, if people had their personal net worth on the line, there would be higher. All the banks would be better capitalized because the directors wouldn't do that. See, my thing is, I disagree with you in one way. I don't think these people are criminal. I just think they're very intelligent. And the way the game is structured, if they take lots of risks, they get to make lots of money, and there's a very good chance they walk away before it all blows up. And if it blows up, they still walk away.
That's exactly right. That's what happened in 2008, and it'll happen again.
All right, one more question about this, and then I want to get to what's in your new book. The thing I think that went wrong, and I know you know way more about the VAR models than I ever will, but in layman's terms, what I think went wrong on these things is that the people who were constructing them expected for the markets to be rational and expected sort of for the outcomes to be evenly distributed. And I don't think they realized how much the risk of their debt ended up skewing the markets so that the other participants began actively trading against them because they knew that they were a weak hand. And I bring this up in particular because of the situation right now that I see in the corporate debt markets. Junk bonds, high-yield bonds have never really traded at a smaller, tighter spread to U.S. Treasuries. And so in May of last year, the average high-yield bond was paying less than 5%. And you know that at some point in the cycle, the default rate on this, in terms of the all of outstanding, will be somewhere around 8 to 10%. So how could these people hope to make money at these yields, knowing that there is so much low-rated paper out there, knowing that there is so much issuance of these, PIK bonds, that you can pay it or you don't have to pay it bonds? Don't you think that folks are going to gradually begin to restrict credit to that market because they know that by doing so they will trigger defaults and be able to buy that paper for 40 or 30 cents on the dollar? In other words, aren't there times in the markets where people act in a predatory fashion, especially when it's an issue of debt?
There certainly are times when market participants act in a predatory fashion. Actually, I think we're seeing that in the gold mining sector right now. I just got back from Asia and Australia, and I attended a convention, actually, of thousands of gold miners, and I talked to other miners and mining stock investors in Australia while I was there. And they said, gee, the prices are really down, the stock's beaten down, what a great time to buy. And my answer was, why would I buy you now? I'd rather wait until you go bankrupt and buy you out of bankruptcy. In other words, yeah, you're right, the prices are low and you're in distress, but that's not a reason to come in and invest. That's a reason to wait until you die and buy the carcass. Well, I'm not actually doing that, but I'm just trying to describe how certain investors think about it. That was exactly what happened in long-term capital management, by the way. We lost $4 billion in 2 months. So right in the middle, that was in August and September. So kind of think of September 1st as a break point. September 1st, we were down about $2 billion, but we still had $2 billion left, and we had a balance sheet with trades that were going to make money. I know it sounds funny, but we were losing because the spreads were widening, but the spreads had to come back in at the maturity of the trade. So we could sort of turn to an investor in good faith and say, hey, if you invest at this level, you're going to own the spread, and it's going to come back in. You're going to make a lot of money. And that was a true statement, except the reaction among potential investors is, fine, I agree with you, but why should I do it now? I'll wait till you lose the other $2 billion.
Right, as you have to sell, the spread's going to widen.
A better level, and I'll own the whole thing.
Right.
And that's exactly what happened. So
that's what Buffett did.
That goes on all the time. But just to take the other side of it, Porter.
No, we'll have a question about that though. Did those things in fact happen? Did the banks make the money back that they gave long-term capital management?
Oh, absolutely. They made a profit.
Yeah.
So as I said, they didn't bail us out; they bailed themselves out.
Right, but isn't that funny? Because they basically just you guys. They said, no, we're not going to give you any more credit. Instead, we're going to buy your beaten up trades and make all the profit ourselves.
Well, that is what happened. That's exactly what happened. But coming back to your junk bond analogy, now look. So I agree that kind of behavior does happen. I agree with you on that. However, don't be so sure it's going to happen soon for the following reason, which is that market participants, and I've talked to people in the primary dealer community and investment bankers as well as government regulators, they see a Yellen put, which is the successor to the Bernanke put, which is the successor to the Greenspan put. In other words, in normal, non-manipulated markets, that junk bond debt might go to zero or go to 40 cents on the dollar, and that might be a good place to buy it up, and people might want to take it there so they can do precisely that. Except we don't have normal non-manipulated market. We have markets. We have propped up markets. And so people might say, the reason the spreads are so narrow is because they think the Fed's got their back. And maybe they do. And so it's a tug of war between, the fundamental people who say, normally this paper would be bad, and I could maybe drive it down and buy it at 40 cents on the dollar. They're on one side of the tug of war, but on the other side of the tug of war, you have people who say, hey, the Fed's not going to let that happen. I got a government put. I can make money on it. I get high yield in the meantime, and I don't have to worry about default because the government's going to bail it out. So take your pick. But this is the problem with manipulation. No one knows which way to turn.
All right, let's talk about the death of money. What do you see as the primary fault in the current system of international trade and debt settlement?
The primary fault is that the central banks, which are running the system, are using the wrong models. They think the world operates according to what they call stochastic general equilibrium models. An equilibrium model is kind of like a clock. You wind it up and all the gears mesh and it ticks along, and every now and then it winds down and you have to wind it up again. So when an equilibrium system is perturbed and goes out of equilibrium, you just apply policy in a certain way and bring it back to equilibrium. That's how Janet Yellen thinks about the world, and that's how all these central bankers think about the world. The problem is the world does not operate according to an equilibrium model. The world operates according to a complexity theory model or a dynamic systems analysis. If you understand complexity theory, you would say two things. Number one, they're capable of catastrophic collapse at any time. They tend to grow and grow and grow until they collapse very suddenly and very unexpectedly. And they also exhibit what are called emergent properties, which are things that just seem to come out of nowhere. People call them black swans, but if you analyze it in dynamic system space, they'd be no surprise at all. And so it's like the way I analogize it, Porter, imagine I'm holding a pen in my hand in midair between two fingers, and I say, Porter, I'm going to let go of this pen, and I want you to tell me what's going to happen next. Well, you'd have a mental model that says, well, okay, gravity prevails, we're on the earth, the pen has weight, that pen's going to hit the floor. Well, the Fed has a model that says it's going to float to the ceiling. Now, it's not that you have a crystal ball or that you're smarter than Janet Yellen, it's just you've got the right model, you know what's going to happen next, but the Fed has the wrong model, and they always get it wrong, and they're going to drive this bus over a cliff. So my biggest single concern is that if you think printing money will solve the problem, and the problem's not getting solved, you're going to keep printing money until you destroy confidence and collapse the dollar.
I like the guy, the analyst in Hong Kong who says that Christopher Columbus was the world's first central banker. He had, when he left, he had no idea where he was going. When he got there, he had no idea where he was, and he financed the whole thing with other people's money.
Well, that's not just a metaphor. I've actually met with members of the Federal Open Market Committee and members of the Monetary Policy Committee of the Bank of England privately, behind closed doors in small groups where they could say things they wouldn't say publicly. And they have said that they made it up as they went along. that they actually didn't know what they were doing. And I tell people that don't ever think the Fed knows what they're doing.
Yeah, well, I think that's pretty clear by, the things that I remember. I think I guess it had been Bernanke, but I remember Bernanke assuring us that the mortgage problems in 2007 were, quote, well contained, and that they wouldn't spread to the rest of the economy. And I also can remember him telling, it was Paulson who told us all, the Secretary of the Treasury told us in June of 2008 that Fannie Mae and Freddie Mac were well capitalized, which I knew was an absolute bold-faced lie.
Right.
So basically, the government official's lying when his mouth is open. Okay, so the essential fault is that the folks who are running the international monetary system don't know what they're doing.
Correct.
And they're doing the wrong thing, which is by producing way too much reserves.
Correct.
I have to admit that I have been shocked and completely wrong so far that we haven't seen any kind of great fleeing from the dollar or the treasury market. I would have thought that our creditors would have reacted with a lot more angst, and they haven't. Why do you think people continue to hold on to the dollar, despite the fact that the woman now and driving the bus is out of control?
Well, they're all kind of in it together. I mean, China's the biggest creditor, the biggest external creditor. Do you think China wants the dollar to collapse? China is the dollar's biggest friend. China wants a strong dollar because they hold $3 trillion of U.S. dollar-denominated debt. Porter, there's an old joke in banking. If I owe you $1 million, I have a problem. But if I owe you $1 billion,
you have a problem. Yeah, I know.
Well, we owe the Chinese $4 trillion, which means they have a problem. They don't want to rock the boat. So, and then the Treasury market to this day remains the only market large enough to absorb the kind of capital flows we're seeing. However, there are enough trends in play, including Russia acquiring gold, China acquiring gold, Saudi Arabia feeling stabbed in the back. Well, there are three important legs of the stool supporting the dollar, and they're all looking for ways out. So I talked about this in the book, and I do expect, the problem is when confidence in the dollar goes, it'll go very quickly. It's not something that's going to gradually drip away. It'll start that way, but then it'll accelerate and feed on itself, and it'll happen before people know it. The time to prepare is now, and I really enjoyed talking to you. It's been a great opportunity, and I hope your listeners have a chance to pick up the book, The Death of Money, and I hope they enjoy it.
I'm sure they will. We'll blast it out in our daily e-letter called The Digest, and we'll encourage everyone to read it. It's been a great pleasure talking to you. You've got to be just about the smartest person we've ever had on the podcast, and I truly, sincerely thank you for your time. Before you go, would you do one small thing for us, and that is, would you tell me what you are doing personally to hedge against the risk of a global systematic monetary collapse?
My optimal portfolio is about 20% gold, 20% land, 20% fine art, 20% cash, and 20% alternatives. The alternatives would include hedge funds, particularly in strategies of long-short equity and global macro.
Very good. I want to tell everybody that Jim has two great books out there right now. One is called Currency Wars, and the other one is called The Death of Money. And both, of course, are available on Amazon, as is everything else that's for sale in the world. Jim, thank you very, very much.
You're welcome. Just a quick aside. I do have a website. It's JamesRickardsProject.com.
JamesRickardsProject.com.
Correct. And for people who are interested, what I really recommend is my Twitter feed, @JamesG.Rickards. I put out a steady kind of stream of information about the international monetary system.
Very good.
Okay?
Thanks very much, Jim.
Thank you. Bye.
Bye-bye. So, it was a great conversation. And I don't have my little buddy here with me, so we don't have any banter. But I think he would have asked me, what I think about all that. And Jim is such a smart and accomplished guy, and he clearly has a very distinct view of the world. And I think you'd probably have to read both of his books to really get a grasp of what he's saying, because at the end of the conversation, I really couldn't figure out really what he was after. He told us, I asked him, what's the central problem? And he said the central bankers. And I guess I know that's true, but it just wasn't, I wish he could have gone into a little bit more technical aspects of how the piling up of these reserves is going to affect different markets and affect different investors. So anyway, maybe we can have him back on, and maybe I can do a better job of asking better questions, and maybe we'd have better answers. Of course, if Aaron was here, it probably would have all gone better because he would have been smart enough to come up with something like that. Now, before we go, today is going to be a short show because, like I said, my co-host isn't here to further the banter. But before we go, I did want to get to one thing that came out yesterday. And there's a group called Delbar. And Delbar has been studying actual investor results. They consult with all of the world's big mutual fund groups. And instead of reporting the results the way mutual funds do, and the mutual funds report results by what the fund earns, Delbar studies not what the fund earns, but what the actual investors in the fund earn. And what they have found consistently over the years is that people, of course, tend to buy funds after they've had a very positive period of performance instead of before. And so people consistently tend to buy funds at the top and then, of course, panic and sell them at the bottom. This is something that on the radio show we call buy and fold investing. Okay, so here's the data from Delbar. Over the last 30 years, the Standard & Poor's 500 index has averaged 11% a year return. Okay? But actual investors in mutual funds have only earned about 3.5%. So there's been a dramatic underperformance. Dramatic. And when they study the reasons, it all comes down to a simple and fundamental lack of discipline and or understanding of how equity markets work. So if you are out there and you have had a tough time as a stock market investor, I would like you to think about one thing in particular. Number one, do you find yourself putting more money to work in stocks at periods of market lows like 2002, 2009, or do you find yourself putting more money to work at periods of market highs like 1999, 2000, 2005 through 2007, and I would say 2012 and 2013 being classic market high forming periods? And the answer, of course, is if you're like most people, you find it way more comfortable to put your investments into the market when times are good and stocks are going higher. But if you want to be successful, you have to somehow learn to do exactly the opposite. And Warren Buffett has the best quote out there for understanding this dynamic. You have to learn to be greedy when other people are fearful, and you have to learn to be fearful when other people are greedy. It's really that simple. So I started warning people about a top forming in the stock market last June. And I said that because I saw that stocks had gone straight up for 18 months. The valuations in a lot of companies had gotten absurd, Facebook being an example, and that there was a huge problem looming in the corporate bond market. And bond markets are larger than stock markets. So stock markets inevitably are sort of the tail on the dog of the bond market. How could bonds continue to go up when high yield corporate debt was trading at less than 5% yield? I know the average default rate for the cohort of that debt will probably end up being around 30%. So knowing that corporate bonds generally have an average lifespan of 7 years, how can you make money buying the entire market when you're going to only get paid 5%? So let's say you get paid 6 years of interest, right? You're going to get paid 30% total in interest, but the default rate on the entire cohort will inevitably end up being 30%. We know this because of historical results. So in other words, you're buying bonds and you aren't going to make any money over a 6-year period. Well, if that's the outlook for the potential return of the bond market, it only stands to reason that the potential outlook for the stock market had to be equally as bad, if not worse. So when people started getting greedy, when people started bidding up the prices of junk bonds to record highs, I started getting fearful. Did you? I just want to encourage you to think that way for all of your investments. Can you learn to build cash when other people start getting greedy? That's a very hard thing to do, because you're going to miss out on some big returns in the short term. Next, do you have the ability to understand value enough so that when the markets fall, you're comfortable buying? And I can give you a great example of that. There was a point in the spring of 2009, it was late February, where I recommended investing in Tiffany & Company, the legendary global brand, the jewelry retailer. At the time, the stock was trading for between $22 and $24 a share. And I did a calculation based on their balance sheet that showed, not including the value of their brand, that if you just sold all of their inventory, if you just liquidated, you sold all of their inventory, you could have paid off their entire enterprise value, meaning all of their debt, and bought back all of their stock. So Tiffany could have gone private simply for the value of their inventory. That assigns no value to their brand, assigns no value to the unbelievable customer relations they have around the world, and assigns no value, none whatsoever, to their future earnings. So, do you think it was more risky for me to recommend shares of Tiffany in February of 2009 when you could get the stock for, like I said, $22 to $24 a share? Or do you think it's riskier to buy it now at $86 a share? Well, the answer, of course, is today at $86 a share. And I don't have any particular view on the relative attractiveness of Tiffany shares today. I have not studied the company since 2009. I'm not trying to bash the stock in any way, shape, or form. I'm just pointing out to you that today, if I just mention the stock of Tiffany, I've got to caution people not to go run out and buy it. Meanwhile, back in 2009, I could have begged and pleaded, and no one would have bought it. No one. In fact, that was part of the Put Strategy report that I launched in October of 2008 because I saw the markets as being so incredibly attractive. I wanted to be leveraged to these kinds of stocks, and I promised investors that they would make at least 50% on average from every recommendation I made, or they could have all of their money back from my product. Not only did we deliver those results, we in many cases we crushed them. I mean, the returns were amazing on a lot of these recommendations. And yet, of course, we couldn't sell the report to save our lives. I think we sold like around 1,000 copies of it at the time. I mean, less than 1% of our subscribers were interested in buying stocks at that time. So that's the biggest lesson. If you can learn that, everything else in investing will be easy. And how do you define when people are greedy? Oh, it's really easy, actually. Couple simple ways. What are the inflows or outflows looking like in equity mutual funds? And of course, as you know, we chart this for you in every month of our newsletter. And equity inflows have been roaring for the last, 18 months, let's say. And then what's the spread between high yield corporate debt and U.S. Treasuries? So in other words, how confident are people that companies out there will be able to repay their loans? Right now, there's record levels of confidence. The spreads between high yield debt and U.S. Treasuries have almost never been smaller. So that's, for me, a critical key sign that people are putting far too much confidence in the corporate bond market. And then the third thing, of course, is simple. It's the blacklist. It's how much stupid money is in the market. How many stocks have been bid up to prices that they can't possibly ever justify. And as I told you recently, there was a record number, as far as I know, a record number of those stocks in the market. So in my opinion, we've had this sort of trifecta of flashing warning signs, and these signs have been going on now, by my count, by close to 9 months. And of course, we've been warning people, and we've been lightening our portfolio, selling some of our high flyers, hopefully encouraging you to do the same. And I knew, though, it would sort of be like pissing into the breeze or shouting into the graveyard. You cannot seem to get people to peel back from an investment mania. And I think that's where we were for the last 6 months. So that's the lesson today, if you will. You've got to figure out when stocks are being embraced too passionately by the crowd, and you have to learn to back away from them at those moments if you want to have good short-term trading results. Now, if you just want to be a long-term investor, it's simple. All you got to do is just learn to be patient and only allocate to value. So whether or not stocks as a whole are going up or going down, you've got to be able to find the pockets of value. And, we can help you do that too in our publications like Extreme Value. And in my newsletter, what we try to do is we try to balance our long-term view with our short-term goals by hedging. So you'll see us add more short positions, and you'll see us talk about building cash and selling stocks going into periods of market overvaluation. The one thing I just hope that you can hear from me and you'll learn is that it isn't actually very hard. the warning signs are as obvious as a red light, a yellow light, and a green light. It's not that tough. All you have to be is a little bit educated and a little bit disciplined. And if you'll follow my letters, I know that I can certainly help you with the education part. The emotional discipline, that's up to you. Okay, so that's it. I apologize for the boring show. It's not nearly as much fun without Brabsy in the house. And we will get to your things like the reader mail, and you've been sending us these incredible stories of your worst investment mistakes. They've been really entertaining and very enlightening, and we will get to a bunch of those next week. And what else? Well, by next week, we'll know whether this sell-off has turned into an official correction or not. So keep your eye on it. And please, whatever you do, follow your stop losses. That's it until next week. Thanks for joining us.
Stansberry Radio is a purely public broadcast and is not intended to be personalized financial advice for any individual specific situation. Each individual's financial situation is unique, and Stansberry Radio should not be relied upon and or considered as personalized advice. Stansberry Radio is not licensed to render personalized advice and should be considered simply the public opinions of Stansberry Radio and its guests. Recommendations on specific financial securities are not intended to address any listener's particular financial situation.